So in the last video, we talked about getting on a budget, right? Once you get your mind right, that was the first video. Second video was step one, the budget. I would call this step 1A. Before we get to investing, I want to talk about one of the things that I learned about in the book, The Millionaire Next Door. In that book, one of the things that I learned, one of the key takeaways is that most millionaires, they get there not by just their own efforts, but they get there by their money working for them in the way that they minimize the tax burden along the way. Let me explain. If you earn 100 grand over the course of a year, right, you're taxed at your tax rate, which right now would be, I think, 22% as of the current tax rate. So 22,000 of the 100,000 will be taxed. But let's say you have that in a Roth IRA, which you can't touch until 59 and a half. We understand that. But if you have that 100 grand in a Roth IRA, and let's say that same 100 grand grew by 20,000, you now have 20,000 that grew that isn't being taxed, right? So your wealth is able to grow faster, compound faster without the burden of taxes. Another situation, let's say you don't want to wait that long. You don't want to put, I think everybody should try to max out their Roth IRA for at least a few years so you get that growth tax free, especially when you're young, because most of the money that's in there is not going to be money that you contributed. It's going to be money that grew from the investment growing tax free. Also, the more money you make as earned income, the more they take, right? So you have to find ways to legally pay less taxes. Roth IRAs, traditional IRAs do the same thing. You can start contributing to an HSA, right? Get all the free and cheap money that you can get. The money that will grow tax-free, the matches that you get at work. If you have a 401k match, that's free money. Take that free money. Get all the free money that you can get, right? The second scenario that I was going to go into, if you don't do the Roth, you can at least put it into an investment account, put it into something that's going to grow, right? Something that you trust, something that will allow you to sleep at night. And then don't touch it for at least a year, because things that you hold for at least a year are taxed differently than things that you hold less than a year. Short-term capital gains tax is higher typically than long-term capital gains tax. It's dependent on how much you earn, right? So if you don't earn very much, you're probably not investing anyways because you don't have enough money to invest. But if you're in a position where you're lucky enough to be able to invest, you have to take advantage of every opportunity to save money on taxes that you can. That's what wealthy people do. And you, as someone who will be wealthy, should be doing the same. Follow for more.